Welcome back to the Airbnb Superhost Secrets podcast. Today we're diving into something that can be a little scary for new hosts, or even like landlords, thinking of trying out Airbnb. Taxes.
Yeah, taxes, they're super important when it comes to being a good host, and it might seem overwhelming at first, but once you break it down, it's pretty manageable, especially if you're starting out here in the U.S., which is what we're going to be focusing on today.
Okay, perfect.
Yeah.
Because I know a lot of our listeners are just starting their Airbnb journey, right here in the States. So first things first, if I start hosting on Airbnb, do I have to pay taxes on that income?
Absolutely. The IRS sees that Airbnb income as income just like a regular job, and Uncle Sam's going to want his cut. That's true, even if you're just renting out a room or just doing it part-time.
So no matter how small my Airbnb operation is, I can't just pocket all the cash and not worry about taxes.
Nope. And here's a little surprise for you. It's not just the nightly rate you have to worry about. It's things like cleaning fees, extra guest fees, even those welcome baskets you might offer. It all adds up and it all gets taxed.
Wait, seriously? The welcome baskets? I thought those were just like a nice gesture.
Oh, they are. But when it comes to taxes, they're part of the service you're providing. And anything you earn for that service is considered taxable income.
Okay, point taken. I'll definitely be keeping better track of those welcome basket expenses. But let's talk about the good stuff. Deductions. What are some of the expenses I could deduct to lower my tax bill?
Well, there's a whole bunch. Just think about advertising costs. Those professional cleaning services you might be using, utilities, property insurance, even your property taxes.
So basically, a lot of the costs that come with running an Airbnb are deductible.
Exactly. You can also deduct things like your mortgage interest, HOA fees, and even some travel expenses related to managing your property. Like, let's say you need to fly out to check on your rental. Well, that flight could be deductible.
Okay, that's good to know. But what if I live in my Airbnb or just rent out a portion of it? Do I still get to deduct all of those expenses?
That's a good question. You do, but you'll have to prorate them. So basically, you're dividing the expenses between the part you're renting out and the part that you're using personally.
So for example, if I rent out 2 rooms in my 4-bedroom house, only half of my utility bills would be deductible.
You got it. It's like having 2 separate properties when it comes to taxes. You got to think of it like splitting those costs between your landlord self and your regular resident self.
Okay, that makes sense. Now let's talk about repairs and improvements. I know there's a difference between what you can deduct immediately and what you have to spread out over time. Can you explain that a bit more?
Absolutely. Just think of it this way. Repairs are like bandages. They fix something that's broken and they get your property back to normal. Those are usually deductible right away.
Okay, so fixing a leaky faucet or patching a hole in the wall would be a repair.
Exactly. But improvements, those are more like giving your property a makeover. They add value or they extend the life of your property. And for those, you have to spread out the deduction over several years. And that's called depreciation.
So if I decide to renovate my kitchen and put in all new appliances, that would be an improvement.
Right. You're making a big investment there that will hopefully increase the value of your property.
Okay, so repairs, immediate deduction. Improvements, we depreciate those over time. Got it. But what exactly is depreciation? That sounds a little intimidating.
It's actually not as complicated as it sounds. Depreciation is just a way for homeowners to recover the cost of their property over time. It recognizes that, property wears down over time, and that wear and tear is part of the cost of doing business.
So instead of deducting the entire cost of my property all at once, I spread it out over several years.
Exactly. For residential rental properties, the IRS typically lets you depreciate the building over 27.5 years. But remember, land can't be depreciated, only the structure itself.
27.5 years, that seems like a really long time. How do I even figure out how much I can deduct each year?
Don't worry, there are formulas and methods to help you calculate it, but it's definitely something to keep in mind, especially if you're thinking about investing in a property specifically for Airbnb.
Okay, this is all starting to make more sense. But what happens if all my expenses, including depreciation, are actually higher than my rental income? Do I end up with a rental loss?
Yes, that's possible. And this is where it can get a little tricky. There are limits on how much of a rental loss you can deduct each year. It depends on things like how much you personally invested in the property and what your other sources of income are.
Okay, so even if I have a legitimate loss, I might not be able to deduct the whole thing right away.
That's right. But don't worry, we'll dive deeper into those loss limitations a bit later. For now, just remember that it's something to keep in mind, especially if you're just starting out and might not see those big profits right away.
Okay, good point. It's all about setting realistic expectations and understanding the full financial picture.
Exactly. And speaking of the big picture, there's one more crucial aspect of depreciation we need to cover. What happens when you eventually sell your rental property?
Oh, right. I bet there are tax implications there too.
Absolutely. When you sell a rental property, you might have to pay capital gains taxes on the profit. But there's some good news. If you've lived in the property as your primary residence for at least 2 of the 5 years before the sale, you might be able to exclude a good chunk of those gains from taxes.
Oh, that's a huge relief. But I'm guessing there are some catches.
Of course. The IRS has very specific rules about what qualifies as qualified use for the exclusion. So if you've been using the property just as an Airbnb rental, those years might not count towards the requirement.
Okay, so if I'm thinking of buying a property and eventually selling it, I need to be strategic about how I use it.
Exactly. If you want to take advantage of that capital gains exclusion, you really need to plan ahead and make sure you're meeting those residency requirements. It's definitely something to discuss with a tax professional to avoid any surprises down the road.
Great advice. So we've covered a lot about income expenses and depreciation, but where do we actually report all this Airbnb activity on our tax return?
Well, there's no special Airbnb form, thankfully. You'll usually report your rental income and expenses on Schedule E of your Form 1040, which is the standard form for individual income tax returns.
Schedule E, got it. So I fill that out, attach it to my 1040, and I'm good to go.
Almost. There's one more form you might need, Form 8582. It helps you calculate those passive activity loss limitations we talked about earlier.
Okay, another form to add to the list. But it sounds like Schedule E is the main hub for reporting all those Airbnb details.
Exactly. It's where you'll list everything about your rental property. Your income expenses, depreciation, the works. And remember those prorated expenses we discussed? Well, the portion you're using for your personal residence might be deductible on a different form, Schedule A. That's where you itemize deductions. And it might make sense to do that if you're a homeowner.
Okay, so it's all about finding the right forms and putting the right numbers in the right places. Sounds simple enough, right?
Well, simple might be a stretch, but it's definitely manageable. And remember, there are tons of resources out there to help you, like tax software and professional advisors.
Speaking of help, what if I hire people to help me manage my Airbnb, like
Sure.
cleaners, handymen, or even property managers? Do I need to report those payments?
Absolutely. Those payments are important to keep track of. If you pay an independent contractor $600 or more in a year, you'll need to issue them a Form 1099 MISC, which reports those payments to the IRS.
Form 1099 MISC.
Got it.
It seems like as Airbnb hosts, we're basically running mini businesses when it comes to taxes. We have income to report expenses, to track forms to file, and potentially even contractors to manage.
You hit the nail on the head. Think of it as your own little rental empire, complete with its own set of tax rules. But hey, with great responsibility comes great tax benefits.
Right, and hopefully some great profits from those Airbnb bookings as well.
Well, that's the ultimate goal, isn't it? To create a successful and profitable Airbnb business.
Absolutely. But before we get ahead of ourselves, let's dive into how this rental income actually gets taxed at the federal level. What are the tax rates like?
For federal income tax, your net rental income, that's your income after deducting all those allowable expenses,
Yeah.
gets taxed at your ordinary income tax rates, just like your regular salary or wages.
So no special lower rate for rental income. That's a bummer.
Unfortunately, no. The rates really depend on your filing status and your overall income level.
Okay, so if I'm already in a high tax bracket, my Airbnb income could be taxed pretty heavily.
Yeah, that's a possibility. It's all part of the bigger picture when it comes to your total tax liability.
Right, so it's something to definitely consider when setting my nightly rates and managing those expenses.
Exactly. Every dollar counts, especially when it comes to taxes.
Now, we focused a lot on federal taxes, but what about state taxes? Do those apply to Airbnb income too?
You bet. It really depends on the state where your rental property is located and where you actually live. Some states have income tax, some don't. And the rates and rules can be all over the place.
So it's not a one-size-fits-all situation when it comes to state taxes.
Definitely not. You'll need to do your research or talk to a tax professional to figure out the specific rules for your state.
Okay, yet another reason to keep meticulous records and maybe get some expert advice. Now, we've talked about paying taxes on rental income, but is there anything else we need to be aware of throughout the year?
Yes, don't forget about estimated tax payments.
Estimated tax payments. What are those?
Think of them as like paying your taxes in installments throughout the year, rather than waiting until tax season to pay one big lump sum. Since your Airbnb income isn't subject to withholding like your regular job, you might need to make estimated payments to avoid penalties for underpayment.
Penalties.
Yikes.
Definitely don't want to mess with those. So how do I know if I need to make estimated payments, and how often do I need to do it?
It can be a bit complicated, but a good rule of thumb is to just talk to a tax professional. They can help you figure out if estimated payments are necessary based on your specific income and deductions.
Makes sense. It's always better to be safe than sorry, especially when it comes to the IRS.
Absolutely. And speaking of being safe, let's talk about record keeping.
Yeah.
What kind of documents should Airbnb hosts be keeping throughout the year, just in case the IRS comes knocking?
That's a great question. What should we be holding on to?
It's all about being prepared. Keep those receipts for every single deductible expense, no matter how small. Track those cleaning service payments, those utility bills, even receipts for supplies for your welcome baskets.
Receipts for everything. That's going to be a lot of paperwork.
It might seem like a lot, but trust me, it's worth it in the long run. Having those receipts can really be a lifesaver if the IRS ever audits you. You'll also want to keep a log of how many days you rented out the property versus how many days you used it personally.
Right, because those proration calculations we talked about earlier.
Exactly. And don't forget about those receipts for repairs and improvements. You'll need them for depreciation calculations and potentially to offset those capital gains when you sell the property.
Okay, receipts, logs, property records. It sounds like we need to create a pretty comprehensive filing system.
Think of it as painting a clear picture for the IRS. Transparency is key when it comes to taxes.
Well, after this deep dive into Airbnb tax essentials, I'm feeling a lot more informed, but also a little overwhelmed by all the details.
I understand. Taxes can be a complex beast, but don't worry, you don't have to become a tax expert overnight. The key is to just understand the fundamental concepts. Keep good records and get professional guidance when you need it.
It's a marathon, not a sprint. Just like becoming a superhost, mastering Airbnb taxes takes time and effort.
Exactly. But the rewards can be significant, both for your bank account and your peace of mind.
Speaking of rewards, let's talk about those juicy tax deductions that can help us maximize our profits. Are there any common deductions that Airbnb hosts often overlook?
Absolutely. One that often gets missed is the home Audits deduction. If you have a dedicated space in your home used exclusively for managing your Airbnb business, you might be able to deduct some of those home-related expenses like rent or mortgage interest, utilities, and even property taxes.
Wait, seriously? So even if I don't rent out my entire home, I might still be able to get a home office deduction?
That's right. But the key is exclusively. You can't just claim your dining room table where you occasionally check your Airbnb messages. It really needs to be a separate space used solely for your Airbnb business.
Okay, so like a dedicated desk in the corner of my living room probably wouldn't cut it.
Probably not. But let's say you have a spare bedroom that you converted into an Airbnb command center with a desk, a computer, all your files. And that's a perfect example.
Okay, home office deduction check. What other deductions do hosts often miss?
Another big one is depreciating furniture and appliances. A lot of hosts focus on depreciating the building itself, but they forget about those furnishings that are also contributing to your rental income.
Oh, you're right. Those stylish couches and fancy coffee makers aren't cheap. We can depreciate those too.
Absolutely. They have a limited lifespan, and they're helping you earn that rental income, so they qualify for depreciation deductions.
Wow. I'm starting to see that being a savvy Airbnb host means being just as savvy about taxes.
Exactly. It's all about understanding the rules and using those deductions to your advantage.
Speaking of using things to our advantage, what about those repairs and improvements we talked about earlier? Is there a clear line between what's considered a repair and what's an improvement?
That's a great question. And sometimes it can be a bit tricky. Repairs are expenses that keep your property in good working order without adding significant value. Think of it like fixing a leaky faucet or patching up a hole in the wall. Those are essential maintenance tasks that keep your Airbnb running smoothly.
So repairs are like routine checkups for your property, just keeping things in tip-top shape.
Exactly. Now, improvements are a bit different. These are changes that add value, prolong the life of your property, or adapt it to a new use.
So like renovating a bathroom or adding a deck?
Precisely. Those are upgrades that enhance your property and potentially boost its value.
Okay, so repairs are deductible right away,
hmm
and improvements need to be spread out over time through depreciation.
You got it. It's all about understanding the difference and treating those expenses accordingly. But remember, there are always gray areas, so when in doubt, consult a tax professional.
Right. Better to be safe than sorry with the IRS.
Absolutely. It's all about making informed decisions and understanding the tax consequences. Now, before we move on, I want to touch on one more important aspect, record retention. How long do we need to keep all those tax documents? Is there a statute of limitations?
That's a great question. I'm guessing those receipts are going to pile up pretty quickly.
They will. Generally, you should keep records that support your tax returns for at least 3 years from the date you filed or the due date, whichever is later. However, there are some situations where you might need to keep records for longer.
Okay, so 3 years is the general rule of thumb, but it sounds like it's better to err on the side of caution and keep them a bit longer, just in case.
I agree. It's always better to be over-prepared than to be scrambling to find missing documents years down the road.
Especially if the IRS decides to come knocking. So receipts, logs, property records, it's all about creating a paper trail that tells the story of our Airbnb journey.
Exactly. And a clear story can make all the difference when it comes to taxes. It's really fascinating how Airbnb has changed the way people think about their homes. It's not just a place to live anymore, it can also be a source of income.
It's true. And that's why understanding the tax side of things is so important.
Yeah.
We're not just dealing with our personal finances anymore. We're kind of stepping into the world of business, even if it's on a small scale.
Exactly. And that's where those rules about at-risk limits and passive activity come in. They might sound a little complicated, but they're really there to make sure everyone's playing by the same rules.
Right? It's all about keeping things fair. Now, let's talk about something I know a lot of new hosts are eager to learn about: maximizing those deductions. Are there any strategies you can share to help us legally lower our tax bills?
Absolutely. First and foremost, be organized. Don't just toss those receipts in a drawer and hope for the best. Create a system, whether it's a spreadsheet, an app, or even good old-fashioned folders to categorize and track all those expenses.
Okay, organization is key. What else can we do to make sure we're not missing out on any potential deductions?
Don't be afraid to think outside the box. For example, if you offer unique amenities like bicycles, kayaks, or even a Netflix subscription for your guests, those costs might be deductible.
Seriously. So it's not just about the basics like cleaning supplies and utilities?
Nope. It's all about creating a memorable experience for your guests, and those extra touches can make a big difference for your reviews and for your tax return.
I love that. It's a win-win situation. Now let's talk more about depreciation. I know it's a powerful tool for homeowners, but I still find it a bit confusing. What are some common mistakes hosts make when it comes to depreciating their properties?
One common mistake is not accurately separating the value of the building from the land. Remember, only the building can be depreciated.
Right, we talked about that earlier. The property tax assessment can be a good starting point,
Yeah.
but we might need a professional appraisal for a more accurate breakdown, right?
Exactly. Getting that initial valuation right is crucial for calculating your depreciation deductions over time.
Okay, so accurate cost basis allocation is important. What other depreciation pitfalls should we avoid?
Another common mistake is forgetting to depreciate those improvements we make to the property. Whether it's a bathroom remodel or a new roof, those costs can be depreciated too.
Right. Even though we might have paid for those improvements all at once, we can't deduct the entire amount right away.
That's right. Depreciation is a gradual process, and it's important to track those improvement costs separately and apply the correct depreciation schedule.
Depreciate those improvements.
Got it.
Got it. Any other depreciation tips you can share?
One more. Be aware of something called the mid-month convention. It basically means you can only claim half a month's worth of depreciation for the month you start or stop renting out the property.
Mid-month convention. That sounds pretty technical. Can you break it down for me?
Basically, if you start renting out your property in, say, July, you can't claim a full year's worth of depreciation. You only get to claim depreciation for half of July and then the full months from August to December.
Oh, I see. It's like a prorated depreciation situation.
Exactly. It's all about those little details that can add up when it comes to your taxes.
Speaking of details, let's dive into a scenario that I know a lot of new hosts are curious about. What happens if I only rent out my property for a short period each year? Let's say I have a vacation home that I use personally most of the time, but I list it on Airbnb for a few weeks during the summer. How do taxes work in that situation?
That's a great question, and it all comes down to how the IRS defines personal use versus rental use. Remember how we talked about dividing expenses based on how you use your property?
Right. And I'm guessing there are special rules when you're using the property for both personal vacations and short-term rentals.
Exactly. The IRS wants to know if you're primarily using the property as a home or as a rental business.
Okay. So how do they determine that?
There's a specific rule that says you're considered to be using the property as a home if you use it personally for more than 14 days or more than 10% of the total days it was rented out, whichever is greater.
So if I rent out my vacation home for 2 weeks, I can use it personally for up to 2 weeks without it being considered a home.
Exactly. But if you rent it out for, say, a month, You can only use it personally for a maximum of 3 days without triggering that home classification.
Okay, I'm starting to see how this works. But what happens if I do go over that personal use limit and my vacation home is considered a home for tax purposes? Does that affect my deductions?
It can. If you use the property as a home and rent it out for less than 15 days during the year, you don't have to report any of that rental income. But you also can't deduct any rental expenses.
Interesting. So it's like a tax-free rental situation if I keep it under 15 days.
Exactly. But if you rent it out for 15 days or more, even if it's considered a home, you'll need to report all the rental income, and you can deduct rental expenses, but only up to the amount of your rental income.
So 15 days is the magic number.
Hmm.
Below that, I'm in the clear. Above that, I need to report the income and can deduct expenses up to that amount.
You got it. And remember, even if you don't have to report the income because it's under the 15-day threshold, it's still a good idea to keep good records, just in case the IRS has questions.
Right. Documentation is key.
Right.
It seems like for those of us who are renting out vacation homes or doing short-term rentals, understanding these personal use rules and that 15-day threshold is crucial.
Absolutely. It can make a big difference in how your rental income and expenses are treated by the IRS.
Now, we've talked a lot about federal taxes, but I know many of our listeners are probably wondering about state and local taxes as well. Do those apply to Airbnb income?
Yes, they do. It can get a little complicated because every state and even some cities have their own set of rules and regulations for short-term rentals.
Oh boy. So it's not as simple as just figuring out our federal tax obligations. We need to do our research on the local level too.
Exactly. Some states and cities require you to collect and remit occupancy taxes, similar to what hotels do. And there might be specific licensing or registration requirements for short-term rentals.
So it's not just about income tax. There could be a whole other layer of taxes and regulations to navigate.
That's right. It's important to check with your state and local government websites or consult with a tax professional to make sure you're complying with all the rules in your area.
Okay. Yet another reason to be organized and proactive when it comes to taxes. It sounds like a good strategy, is to create a checklist of all the potential tax obligations based on my location.
That's an excellent idea. A checklist can definitely help you stay on top of things and avoid any surprises.
Now let's talk about something that can be a bit stressful for new hosts, audits. What are some red flags that might trigger an IRS audit, and how can we avoid them?
One of the biggest red flags is claiming excessive deductions or losses that seem out of proportion to your rental income. The IRS is always looking for inconsistencies, so it's crucial to be realistic and accurate with your reporting.
Right. It's tempting to try to deduct everything under the sun, but honesty and accuracy are key.
Exactly. Another red flag is failing to report all your rental income. Remember, the IRS gets copies of those 1099-9K forms from Airbnb.
Oh, right. So the IRS already knows how much we're earning. There's no hiding from Uncle Sam.
Nope. Transparency is key. Make sure your reported income matches what Airbnb has reported to the IRS.
Transparency and honesty. Got it. Any other tips for staying on the IRS's good side?
One final piece of advice, stay informed. Tax laws are constantly changing, so it's important to keep up with the latest updates. Subscribe to IRS newsletters, read relevant blogs and articles, and consider attending workshops or webinars on Airbnb taxes.
So it's not a one-and-done situation. Tax education is an ongoing process for Airbnb hosts.
Exactly. Consider it an investment in your business, just like any other professional development activity.
Well, this has been incredibly insightful, but I'm not going to lie, it's also been a little overwhelming. There are so many details to keep in mind.
I understand. It can be a lot to digest. But remember, you don't have to figure it all out on your own. There are resources and professionals available to help you navigate the complexities of Airbnb taxes.
That's reassuring.
Good.
So where can our listeners go to find those resources and get that expert guidance? What are some good starting points?
The IRS website is a great place to start. They have tons of information on rental income and expenses, including publications and FAQs specifically for taxpayers with rental activities.
Okay, so straight to the source. What about professional help? Who should we be looking for?
If you're looking for personalized advice, consider talking to a certified public accountant, CPA, or an enrolled agent, EA. These tax professionals have specialized knowledge and experience in dealing with rental income and can really guide you through the ins and outs of tax filing.
So CPA or EA, someone who specializes in rental properties ideally.
Exactly. They can help you maximize your deductions, avoid common pitfalls, and make sure you're in compliance with all the relevant tax laws.
It sounds like finding the right tax professional can be a game changer for Airbnb hosts. It can take a lot of the stress and guesswork out of the process.
Absolutely. Having a trusted tax advisor on your team can give you peace of mind and allow you to focus on what you do best, creating amazing experiences for your guests.
Well, that's great advice. Knowing where to find the right resources and support can make all the difference. Now, before we wrap things up, I want to revisit something we touched on earlier, those tricky passive activity loss limitations. Can you explain those in a bit more detail, especially for those hosts who might be starting out and facing potential losses in those early stages?
Of course. Remember how we talked about how rental income is considered passive income by the IRS? Well, there are specific rules about how much passive loss you can deduct against your other active income, such as wages from a job.
Right. I remember you mentioning that. But can you give us a concrete example of how it works? I think that would help our listeners understand the concept better.
Absolutely. Let's say you have a full-time job and you're also starting out as an Airbnb host. In your first year of hosting, you end up with a rental loss of $10,000. However, the passive activity loss rules might limit how much of that loss you can actually deduct against your job income.
So even though I have a legitimate loss, I might not be able to use the full $10,000 to reduce my overall tax bill.
That's right. The amount you can deduct each year depends on your income level and how actively you participate in managing your rental property.
Okay, so if I'm more hands-on with my Airbnb, setting rental rates, handling bookings, and managing repairs myself, I might be able to deduct more of that loss.
Exactly. The IRS recognizes that if you're more actively involved, your rental activity is closer to a business than a passive investment.
That makes sense. So what's the takeaway here for new hosts who might be facing potential losses in those early stages?
The key is to understand those passive activity loss limitations and to plan accordingly. If you're expecting losses in the beginning, it might be helpful to talk to a tax professional to explore strategies for minimizing their impact on your overall tax liability.
Great advice. It's all about being proactive and seeking expert guidance when needed. And speaking of expert guidance, we've covered so much valuable information today, from income and expenses to depreciation record keeping and even those tricky passive activity loss rules. But I know our listeners are probably eager to learn even more. Are there any other resources or tips you can share to help them continue their tax education journey?
Absolutely. There are some fantastic online resources out there specifically for Airbnb hosts. Websites like Airbnb's Help Center and reputable tax blogs can offer valuable insights and guidance on tax-related topics.
Okay, so there's plenty of information available online. But what about those hosts who prefer a more hands-on, interactive approach? Are there any in-person workshops or courses they can attend?
Yes, definitely. Many communities offer workshops and seminars specifically focused on Airbnb taxes and regulations. These events are a great way to learn from experienced professionals, network with other hosts, and get answers to your specific questions.
That sounds like a great way to stay up to date and build a support network. And speaking of support networks, I'm sure many of our listeners have friends or family members who are also involved in real estate or investing. Is it a good idea to tap into those personal networks for advice?
Absolutely. Talking to people who have experience in real estate or business can be incredibly valuable. They can offer insights, share their own experiences, and potentially connect you with resources you might not have even known about.
So it's all about building a network of trusted advisors and mentors to help us navigate the complexities of Airbnb hosting.
Exactly. And remember, you're not alone on this journey. There's a whole community of Airbnb hosts out there, all facing similar challenges and opportunities.
That's really reassuring. It's like we're all part of a big supportive family.
That's a great way to put it.
Mhm.
And with the right knowledge, resources, and support, we can all thrive in this exciting world of Airbnb hosting.
Well, that's a perfect note to end on. But before we wrap up this part of our deep dive, I want to remind our listeners that understanding the tax implications of Airbnb hosting is crucial for success.
Absolutely. It's not just about maximizing your profits, it's also about building a sustainable and responsible business.
Right, and that includes staying informed about our tax obligations and making smart decisions throughout the year.
Exactly. So embrace the tax side of Airbnb hosting, seek out knowledge, and don't be afraid to ask for help along the way.
Great advice. And on that note, we'll take a quick break and be back soon with the final part of our deep dive into Airbnb taxes. Stay tuned. Welcome back to the Airbnb Superhost Secrets podcast. We've been really diving deep into this whole world of Airbnb taxes, and I got to say it's been a lot to take in.
It definitely is, especially for those new hosts. But remember, you don't have to become a tax expert overnight. The key is understanding the basics and knowing where to go for help when you need it.
Exactly. And speaking of help, we've talked about the IRS website and those professional advisors like CPAs and EAs. Are there any other tools or platforms out there that can help hosts manage their taxes more efficiently?
Oh, absolutely. There are some great software programs designed specifically for Airbnb hosts and other, short-term rental operators. These platforms can help you keep track of your income and expenses, generate reports, and even estimate your tax liability throughout the year.
Wow, that sounds like a lifesaver.
Yeah.
So it's like having a virtual tax assistant to keep everything organized and on track.
Exactly. These programs can really streamline the whole process and save you a ton of time and headaches, especially if you're managing multiple properties or dealing with, those really complicated bookings.
Okay, tax software is definitely something to look into. Now let's shift gears a bit and talk about something that I think is often overlooked: insurance. We know it's important to have insurance for our properties, but are there any specific insurance considerations for Airbnb hosts?
That's a great question, and it's something all hosts should really think about carefully. Standard homeowners or renters insurance policies often have exclusions for business activities, and that includes short-term rentals.
Oh, wow. So my regular insurance might not cover me if something happens while a guest is staying in my Airbnb.
That's right. It's super important to check your policy and talk to your insurance agent to make sure you have the right coverage for short-term rentals. Some insurance companies offer specific endorsements or riders to cover Airbnb activities, or you might need to consider a separate short-term rental insurance policy.
Okay, insurance is definitely not something we can just ignore.
Yeah.
We got to protect ourselves and our investments.
Exactly. And speaking of protection, another area to think about is liability. As an Airbnb host, you're opening up your home to people you don't know, and there's always a risk of accidents.
That's true.
Mm-hmm.
Even if I screen my guests really carefully, things can still happen that are out of my control.
Exactly. That's why it's important to have a good liability waiver in place, to protect yourself if a guest gets hurt on your property or causes any damage.
So liability waiver is like a legal safety net for us hosts.
Exactly. It spells out everyone's responsibilities, and it can really help protect you in case of something unexpected. You can find templates for liability waivers online or talk to a lawyer to get one that's tailored to your specific needs.
Great advice. Now let's talk about something more fun: the guest experience.
Mhm.
We all know how important it is to give our guests an awesome experience, to get good reviews and those repeat bookings. But are there any tax implications when it comes to the guest experience? Like, can we deduct the costs of those welcome baskets or other amenities?
Absolutely. Remember we talked about how all the income you earn from Airbnb is taxable? Well, the good news is that a lot of the expenses you have to provide that service are deductible.
So if I'm spending money to make my guests happy, those costs can actually help lower my tax bill.
Exactly. It's a win-win situation. So keep those receipts for everything, those welcome baskets, those Netflix subscriptions, extra towels and toiletries, it all adds up.
Okay, so it's not just about the basics. Those little extras that make a stay special can really pay off in more ways than one.
You got it. It's all about balance, providing a great experience and keeping track of those business expenses.
Now, before we wrap up this whole deep dive on Airbnb taxes, I want to go back to something we talked about earlier: the importance of getting professional help. Taxes can be so confusing, and even experienced hosts might need some expert advice.
I totally agree. Don't be afraid to reach out for help, especially if you have a complicated tax situation or if you're just starting out and feeling a little lost. A good tax professional can be so helpful for your Airbnb business.
Right? It's like having a co-pilot to help you navigate all those tricky tax rules.
Exactly. They can help you understand what you need to do, maximize your deductions, and make sure you're doing everything by the book. And the cost of their advice is often tax deductible, too.
That's a good point. So getting some expert help can actually save you money down the road.
Exactly. It's all about making smart choices and setting yourself up for success.
Well, this has been super informative. I think we've covered pretty much everything from income and expenses to depreciation, record-keeping, insurance, and liability.
It's a lot of information, I know. But the key is to take it one step at a time. Stay informed, and don't be afraid to ask for help.
And on that note, we'll wrap up this episode of the Airbnb Superhost Secrets podcast. We hope you found this deep dive into taxes helpful.
Happy hosting, everyone.
And remember, as always, consult with a tax professional to get advice for your specific situation. We'll see you next time.